Hello to all you passive income investors looking to build dividend income. In this video, I'm going to bring you one dividend stock that yields 5.2% that I think makes an excellent investment for passive income investors. But I'm also going to discuss why I think it's an excellent dividend stock to buy. You see, there are certain characteristics that I look for when I'm looking at a dividend stock, and it's more than just the dividend yield. So I'm going to share with you those things that I look for and why I found them in this stock and why I think it could make an excellent investment for you. So without further ado, let's jump right in. Let's see what this dividend stock is.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the dividend stock that I will be discussing in this video is Verizon. So let me share with you the characteristics that I like about Verizon's business and why I think it makes a good fit for passive income investors. Starting with, I want to point your attention to this area here. I've highlighted its cash flow from operations in the 9 months that's ended September 30th, and this is comparing 2023 with 2022. And you'll notice that it increased to 28.8 billion in 2023, up about 600 million from 2022. Importantly, its capital expenditures dropped from 15.8 billion down to 14.2 billion in 2023. That's a 10% drop, a drop of 1.6 billion. This is a reduction of all of the 5G investments that the company has had to make over the past several years, and it's indicative of the company and its business model. Every new cycle of technology, Verizon needs to invest massive capital to build out and upgrade the technology, the connection. So this latest one was 5G. And you could see with the decline in CapEx that it's towards the end of that investment cycle. And going forward over the next several years, it's going to reap the benefits of those investments it made in 5G. Importantly as well, Verizon has proven it can do this over several cycles. And that's a capability that is attractive for passive income investors because it demonstrates to you that Verizon can continue sustain its business longer term. It won't be disrupted by a new technology. It can upgrade and sustain, right? And it's done that with 3G, with 4G, with 5G, and it's demonstrated it can do that. So with whatever the next thing is, Verizon can invest and upgrade. And the combination of the increase in cash flow from operations and the decrease in CapEx increased Verizon's free cash flow from 12.4 billion to 14.6 billion. That's an increase of 2.2 billion, and that's important for dividend stock investors because this free cash flow can be returned to shareholders through dividends. So it's not just the current dividend yield that Verizon is paying, it's also that it looks like over the next 5 years, it's going to have more cash flow to distribute as dividends. And so the current dividend per share, you can reasonably expect it to rise over the next 5 years. Another reason why Verizon makes an excellent investment for passive income investors, look at this 0.9% wireless retail postpaid phone churn. What does this mean in layman's terms? This means that over 99% of Verizon's customers stick around, right? They're not canceling, they're not switching. Over 99% renewal rate. That's really good for a dividend paying company because that's recurring stable cash flow that's coming in that the company can use to make upgrades, to pay expenses, and leave over to pay dividends. Also, Verizon saying that the priorities for the end of the year is to continue momentum in consumer mobility with segmented and disciplined approach. Now, if you're not aware, businesses typically speak to each other through public statements like this. And this, when Verizon releases an update like this, you better believe that AT&T, T-Mobile, and other wireless providers are paying close attention. And when Verizon says we're going to take a disciplined approach, this is a signal to the other wireless providers that says we're not going to do any major promotional activity. We're not going to offer major discounts. We're not going to offer major incentives. We're not going to increase advertising. We're not going to try and steal your customers. Okay, so that's Verizon sending a message to others. And wouldn't you know, AT&T said a similar thing. They said we're taking a disciplined approach as well. And so that's communication between each other saying we're not going to go after your customers as long as you don't come after our customers. You make good profits, we make good profits. Let the customers pay higher prices. And so that's good news for investors, but not good news for customers, of course. But as a dividend stock investor, you like to see this. You don't want to see the companies that you're investing in entering into major competition, offering discounts and all of that stuff, because that's going to bring down profitability and that's going to increase the risk that the dividend could be paused or reduced in the next year or two. So I mentioned Verizon's dividend yield 5.23%, but I also talked about the factors that could lead to an increasing dividend payment over the next few years. So as a dividend stock investor in Verizon, you can reasonably expect it to increase the dividend per share over the next few years. Verizon's operating profit margin over the last decade has held firm despite a brief decrease here in 2015. For the most part, it's held firm above 20%. That's a really good operating profit margin. I look at anything above 10% as a good profit margin, operating profit margin. In the 20s, it starts to be really good. And in the 30s, you're starting to look at excellent. The highest company operating profit margin that I know of is Visa at 67%. And now that's in the rarefied air territory. Very few companies have operating profit margin in that range. So 22% is good. It's really good. And Verizon, similarly, cash flow from operations to sales held at 28.14% in the most recent update. Every $100 in sales turns into $28 in cash flow from operations. That's a really good conversion rate as well, similar to the operating profit margin. Of course, a major risk with investing in Verizon stock is the $147 billion in debt that the company has. Although this is less risky because the company generates the cash flow from operations that's enough to support this long-term debt, and also that the company has 99% of its customers returning, and so it makes it less risky, but still it's a risk nevertheless. Another risk with Verizon is what I talked about earlier, in that every several years it needs to upgrade in that new technology, and so that's going to be billions of dollars that it needs to invest every new cycle of technology, and there is no guarantee that those investments will pay dividends. And so the recent one the 5G has been effective and it's reaping the benefits of that, but there is no guarantee that the next technology will. And so that's another risk to look out for with Verizon stock. Although it has proven that it can upgrade and maintain relevancy with customers and retain all its customers, still there's always that risk that it doesn't, right? So there's just something to keep an eye out for. And finally, the price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. Looking at Verizon, it's relatively cheap at a forward PE of 8.183. So for all of those reasons I discussed here, I think Verizon makes an excellent dividend stock for passive income investors to buy in 2024. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.